Hi everyone, with earnings season wrapping up and with the recent massive declines we've seen in the tech sector, we thought we'd do a stock analysis on Palantir, ticker symbol PLTR. We really appreciate our viewers' interest and especially love hearing your comments. And Lai asked if we would do a video on Palantir. So Lai, here it is. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. So this video on Palantir shouldn't be considered a recommendation to buy or sell the stock, but we hope as we evaluate this company that for educational purposes, you'll begin to understand a little bit better about how we think and invest, and understand the investment framework that we use here at YCG. Okay, so with that, let's dive into an analysis on Palantir, ticker symbol PLTR. Many of you already know what Palantir is, but for those of you who don't, Palantir Technologies Incorporated builds software platforms for institutions. The company operates two segments: commercial, which serves customers working in non-government industries such as banks and airlines and healthcare industries, and the second segment is government, which serves customers that are agencies in the United States, federal government, and non-United States governments as well that are allies with the United States. The company's built two software platforms, Gotham and Foundry. Gotham is a software platform which is constructed for analysts at defense and intelligence agencies. Gotham enables users to identify patterns hidden within the data sets, large data sets that they have, ranging from signals, intelligence sources to reports from informants, and helps the United States and allied military personnel. Foundry creates a central operating system for organizations' data where individual users can integrate and analyze their data. Palantir is a high-growth company and currently isn't generating operating profits, but that's because they have their feet on the pedal and spending a lot of their cash on sales and marketing to build up their client-based network. Big data and analysis of that data is a huge growing segment of the marketplace and crosses multiple industries. The potential total addressable market, or TAM, is very large, which is why it attracts so much attention from growth investors. For a new customer, Palantir provides short-term pilots of their analytics to little or no cost, and as the customer or government explores and understands the value of their big data analytics, Palantir then expands and scales their services and products and generates increased revenue sources by upscaling, as it establishes their services as being mission critical to the government and or the commercial organization. Okay, so let's switch over to Refinitiv and look at the quantitative side of things. This is really just the basic analysis of Palantir. Unfortunately, we don't have enough time here to cover the kind of depth we go into before deciding whether it's a stock suitable for client portfolios. But nonetheless, let's take a look. Okay, so here we have logged into Refinitiv. We're looking at Palantir Technologies Incorporated, ticker symbol PLTR, showing the price right now at trading at $24.56. Market is definitely rebounding. The stock is rebounding. You can see the chart here, the two-day price chart. It really has rebounded a lot today. But really, if we go down to the price chart here, we have the highs going at around $39 a share, and it's come down significantly, obviously, with the massive tech sell-off down about 40%, even still at the $22 share price. Well, let's take a look here at some of the financial metrics looking at Palantir. So we're looking this on a calendar year basis. Some key ratios that I think are worth looking at are enterprise value over revenue. We've got about 36 times. In 2021, it's going to go down, obviously, from 26 times to 20 times to about 15 times. So obviously, forecast is for revenues to go up, and obviously the value of the business in general is expected to go up. Total debt right now, there's quite a bit of debt relative to the earnings before interest taxes, depreciation, and amortization, that as earnings go up, though, there's going to be net cash position is what the company is forecasting. Right now, there is no earnings, so there isn't a PE per se, but their forecast is to show that 2021 earnings, all the way to 2023, there will be earnings where it will generate a price-to-earnings ratio of 150 times, going down 110 times to about 90 times. So pretty lofty valuations if that earnings is going to pan out. Some other metrics that we like to look at are returns on tangible assets, and it's really difficult to kind of take a look at these metrics, especially when there are no returns or profitability, which there isn't right now. So if that's the case, returns on assets is really kind of meaningless. But obviously, these returns on assets, it's kind of over the map right here. So 2021's projected to be 12.37%. down to about 1%, and then about 17% returns on tangible assets. So again, I think that number is somewhat meaningless given the fact that the company isn't profitable right now. And again, returns on invested capital is something that we look at, and right now there's just no data really to look at that. So we take a look at the stock or the price performance. Right now it's trading at about $24.50. Today's volume has been about 86 million shares, so very active today, obviously being up about 10%. The year-to-date performance of the stock is about 4.3%, so it's obviously come down significantly from the highs of where we were, and you can see that here in this pretty stock chart. Fairly new company. If we take a look at when it IPO'd, the IPO date was 23rd of September 2020, so very brand new company, yet the market cap right now is showing at about 41 billion as of today. So let's scroll down and let's take a look at the financials. This is important to take a look here. Again, we're looking at a calendar year basis. Revenue for last year was just over $1 billion. They're projecting and forecasting out revenue to be about $1.5 billion, growing to about $2 billion almost in 2022 to $2.5 billion in 2023. Gross margins is something that we really look at a lot. We talk about pricing power, enduring pricing power here at YCG, and gross margins is actually a great metric to look and see if the business actually does have pricing power. And so when we look at gross margins, really strong gross margins, anything, above 30-40%, I would say really strong pricing power. Whether it's enduring or not is another question, but here you can see gross margins in 2020 was 78%, and really another positive sign that we're seeing here in the forecast numbers is our margins expanding. So 81.73% to 83% in 2022 to 87% in projection in 2023. Obviously, there's no earnings or earnings per share, but obviously that's looking like it's going to become profitable going out at the end of this year and in 2022 and 2023 at 25 cents earnings per share. So the future looks bright according to the company and they're forecasting. But right now, again, no earnings, as you can see from the earnings growth chart right here. Interestingly enough, we've got institutional ownership at 21%. And the one thing I wanted to show you here is, I've expanded this view, so hopefully you can see this quite well, but here's the business segment for the company. So it shows the government revenues from 2020. Government revenues were about 55%, commercial revenues about 44%. Now, in my opinion, in our opinion, we want to see the commercial side grow, because I think from the commercial standpoint, it's a lot more profitable. The government can really kind of weigh heavily and request discounted pricing. And I think the commercial side is definitely going to be the more profitable side for Palantir. So you really want to see this revenue growth coming more from the commercial side. But it's great to have this government revenue. I would think that this is kind of the cornerstone part of their revenue sources. Geographic, it's kind of interesting. So 52% of the revenues coming from the United States. The UK is about 12%, and about 9% coming from France, and the rest of the world making up about 26%. Again, because of the government relationship, these are really only going to be the US and allies to the United States as well. Some interesting anecdotes here. Some top investors, Vanguard, JP Morgan, and Soros Fund Management being kind of the interesting institutional investors of the stock. Let's take a look at some of the peers. So Splunk, Datadog being about 20 billion, 23 billion, not half the size of Palantir. Snowflake, which obviously they're having a great day today, up 9% as well. They're valued right now at $60 billion. VMware, same $60 billion. And Adobe, Salesforce, it's a very different kind of peer, but I guess in the software group, Adobe and Salesforce, just from a market standpoint, being $201 and $190 billion. If you found this information useful, then please go ahead and hit that like button. It really does help with the YouTube algorithm analytics and can help our educational videos potentially reach more people interested in this kind of content. We've mainly focused on the numbers, but calculating valuation is the easy part. If the quantitative side made you rich, there'd be a whole host of accountants and mathematicians as billionaires. If you want to learn more about our entire investment strategy, we have a video for that, and the link is in the description below. I think what would be helpful at this point is to look at the Refinitiv quantitative numbers again, but to put them through our YCG investment framework. So let's take a look at this spreadsheet. These are questions that we ask frequently about whenever we're evaluating a new company. And one of the first questions we look at is kind of a competitive advantage. So what are Palantir's competitive advantage? And I would say that there's this increasingly global protocol and data network effects that are obviously the strongest. And with their government relationship, very strong data security, it really bodes well. And obviously there's big data, and the analysis of big data is such a big growing business. And there's high switching costs. So and we'll go into that in a little more detail, but I would think that those are the strong competitive advantages for Palantir. So strong network effect, yes, as more, we talk about this, as more users get added to the network, the more valuable that network becomes, and it's actually exponential, the value of that network. So it compounds on itself. And I would say that the more users, the more analytics that get added to the network for Palantir, the more valuable that data and the analytics becomes. From that standpoint, is the network global? Yes, it is. We saw that in Refinitiv. High switching costs, absolutely. So yes, on that count, when you spend so much time in the data and analyzing, and it becomes such a mission critical part of your business, then yes, Palantir and their services become very valuable. And switching to another provider, there's a lot of costs that come into that. So definitely high switching costs. I put medium for the marginal cost of adding an additional user to the network. I do think there is investment dollars that Palantir need to put into a customer relationship. But I think over time, once they have that relationship, the marginal dollar spent on retaining that customer goes down. So that's why I said medium. Morningstar classifies, obviously being infrastructure software, Is the industry growing at least as fast as GDP? Yes, I think data analytics is definitely a growing market segment, so definitely growing faster than GDP. But is that, when we look at that, we think very long term, and would that be a growing aspect as far as GDP goes? And I think the answer to that is unknown yet. An enduring rank. So are there going to be enduring pricing power? And I think that's where, again, the gross margins, when we look at that, and operating gross margins, they're certainly high right now, but are they enduring? Can they continue to achieve those types of gross margins? And if we're honest, the word enduring is really that key, and the fact is we just don't know. Morningstar Moat has a rating of them having a very narrow moat, meaning that there is the potential for other competitors. Also, governments could create in-house teams to analyze the data, and so it's not a wide moat, it's certainly a narrow moat. They could have very stiff competition, especially if they're generating those kinds of gross margins. So narrow moat rating from Morningstar and from us as well. Very positive moat trend though, because obviously it's growing. From a capital allocation standpoint, they're exemplary. Fair value uncertainty, what that means is basically because there's such a focus on the growth, it's very difficult to know how that's going to pan out in the very long term. And because there are no earnings right now, kind of putting, when we talk about the inverse of the Gordon growth formula, it's almost meaningless because the uncertainty is so high from that standpoint. All right, so here's where the Refinitiv numbers kind of come into the spreadsheet here. Gross margins trailing 12 months has been 78%. Estimated gross margins are going to be 83%. Here's where the analysis shows kind of this uncertainty because of the negative operating margins, negative returns on capital employed, that's negative 79%. Approximate ROTAs, returns on tangible assets, at negative 54%. Again, it's meaningless. The company really needs to be profitable for these very important ratios to actually mean something. Returns on equity, same thing again. Returns on incremental invested capital, it's zero. Again, there's just no return, so makes the analysis or the ratios mean less. So debt is another thing that we look at. We want to look at the capital structure of the business. And the thing that I want to show you here is this. So net debt, including long-term investments and investments in unconsolidated affiliates over EBITDA. Now, if you were to look at a company like Apple, this number is actually about -1. Meaning that they have a net cash position. Right now, Palantir, because this is a positive 1.6%, they actually have more debt on the balance sheet than they have earnings. And so that, is a little bit worrisome, just given that they don't have a strong balance sheet as of right now. But again, very early and new company. Their total enterprise value at about 39. If we skip over here to valuation, so I say here conservative balance sheet, no, not at this time, but valuation here, the enterprise value over future the next year's sales, about 26 times, and then the price over the next 12 months of earnings about 130 times. So again, pretty richly valued, and we saw those numbers in Refinitiv there. Is there an idiosyncratic cultural business model? I would say no from that standpoint. Cyclical, I said no, just because of the recurring revenue that comes from these services, pretty evergreen. If you can retain those customers, and with the government being such a big part of their business model, I would say that those are pretty recurring revenues that are coming. Rent seeking, don't know. Sometimes because it's such a new company, it's difficult to know where management stands on this. What you want are management teams thinking long term and not making expensive short-term expense decisions that really hurt the company in the short run. You really want the management team thinking long term. So I said, don't know. Market timing mispricing. The best types of investment scenarios, in our opinion, are where you have really strong positive trends long term, and the outlook looks really promising from that standpoint. But in the short run, there's kind of short term pain. And I would say that there's kind of an opposite with that. You know, ARK Investment, these other popular growth investors, really moving this stock tremendously. And you know, who's to say? You know, the sell-off today or the last couple weeks, and then today it's obviously rebounding. To me, that there isn't a market timing mispricing where there's, you know, the outlook looks very negative. I would say that it's quite the opposite from that standpoint. Would we consider this as an investment? Yes, possibly. And I think the reason for that is just the strong network effects that become mission critical to either the government or commercial clients, which are obviously growing rapidly, and higher margin clients really kind of coming on board. And obviously with expanding data sets, this could be a situation where winner takes all. And just, you know, having the AI work across multiple industries is just such a huge win for this company. And having high switching costs really creates a network effect that I feel, and we feel, it could be very strong in the future. I think the key reasons why we wouldn't own it, though, at this price is we're just not sure of the enduring pricing power, and just the threat of new entrants vying for these similar gross margins could erode pricing power, enduring pricing power opportunity, and also just the high fair value uncertainty really kind of makes us pause for this time. As you can see, there is a path for Palantir to be extremely successful and to be a lot larger possibly in the future, but one needs to look at all the risks as well as the potential returns. And in our opinion, you want to know what elements are making a stock look attractive. Palantir stock performance could be a fabulous opportunity at current prices, but remember, we're looking for profitable growth, and not all growth is such. Some companies can have high growth but have no pricing power. You can see this with the airline industry historically. It's been one of the fastest growing industries, but you sum up all the profits since Kitty Hawk, and they've actually been negative overall for the sector. Note that Southwest Airlines actually has been profitable by being the lowest cost producer and not necessarily a company that has enduring pricing power. So let's visit valuation again. I know I talked about this in our last stock analysis video on Square, which you can see by clicking the link up here, but let's take a look at stock multiples and take a look at this spreadsheet here. I wanted to show kind of this growth multiple stock chart. Again, we use this for our analysis on Square, but if we take, you know, let's assume the company earns $1 in earnings and they're growing at 20% and they're valued at about 150 times. You know, let's say it dropped in half, the valuation of the multiples of our earnings here. It dropped from 150 to 75. 20% is very strong growth. So you can see here that it would only take about 3 years for that to recover, and then you'd start to see positive rates of return. If this were to drop even further and say, let's say it drops to about 25 times, you can see that this extends further out. It would take about almost 10 years for it to recover if the multiples were to drop from 150 to about 25 times. So again, when you're looking at these growth names, you got to be very careful about the price that you pay, and how sure you are about those earnings and the ability for the company to earn enduring in pricing power. So what are your thoughts on Palantir? We'd love to hear your opinions in the comments section. We currently don't own Palantir in client portfolios, but you can request a complete list of all of our securities recommended by YCG. Thanks for joining us today. Check out one of our other videos. We look forward to seeing you next time. Thanks again.